Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio, we have Jessica Inskip. She's Director of Product and Education at OptionsPlay. We're going to take a look at technical levels to watch in the Nasdaq 100, as well as discuss if the bar is too low for this earnings season. Jessica, it's great to have you with us. Welcome to TradeTalks.
Yeah, great to be here. Thanks, Jill.
You got it. Let's kick it off with earnings season. Has the bar been set too low?
Well, I think this earnings season is really interesting. So the way that I think that the bar has been set very low is we have had the most negative guidance that we've ever received. So it's optional for firms to give us forward-looking guidance. And of the firms that gave us forward-looking guidance, a lot of it was actually very negative, and that negative guidance was mostly from tech, which makes up the most of the S&P 500. So it's something to certainly pay attention to because it drives the markets, but that's it essentially sets the bar low, because now we have this negative connotation that's already priced into the market, so we just have to see how it reacts.
Right, and of course sentiment is just so negative all over the place.
It is.
Where will the focus be for earnings season? What are you listening for?
So I'm really waiting on tech, and I think that's really played out as we've gone through earnings. Even today, we had the regional banks reported today, and that's obviously been really moving the markets, as with the credit crunch and so on and so forth. So tech is something to absolutely pay attention to. Now the narrative is certainly shifting. How is that credit crunch affecting other companies and so on and so forth? But if you also think about what this quarter represents, it's a tale of two halves, if you will. The credit crunch and the banking crisis didn't happen for the duration of the full quarter. It happens towards the end of it. So it means anything that's happened with the credit crunch would really be reflected with forward-looking guidance, not necessarily the earnings that came out.
So what sector has the advantage here?
I really think it's tech. Tech, we are now experiencing this revolutionary AI, and in my opinion, the way that I see AI, it's revolutionary in the fact that it can go across every single sector. AI can be used in healthcare, it can be used in finance, it can be used in technology, it can be used in everything that we use every single day, much like the revolution of the World Wide Web. That was data that created e-commerce, online advertising, things that we never knew that we would need. And so new jobs are certainly be created, but I think the major advantage of tech is the big macro headwind right now is a red hot labor market. And the term that I think Powell likes to use way too often is a labor market imbalance. And one way to bring balance back to the labor market, besides printing people or creating people, which is something the Fed can't do, is increasing productivity, and that's something that artificial intelligence can help with, perhaps bring equilibrium to that labor market imbalance. So that gives tech an advantage from so many fronts. So now the bar's been set low. We have negative guidance from forward-looking guidance from tech. We have had the most earnings slashed ever from tech coming into this season, and that's a record, so that's the bar low. And then in addition to that, tech is at an advantage because not only is AI innovative and can be across multiple verticals, it also solves a major macro headwind for this market.
It certainly does. So let's talk about tech for a second, because when I think of growth and I think about innovation, I think of the Nasdaq 100, of course.
Absolutely.
That is, we definitely have the exposure to technology there. Let's take a look at it from a technical perspective. What levels are you watching, and how would you trade this?
Yeah, so my favorite technical indicators that are applicable actually right now are the moving averages that I look at. I like to take it back to the basics, but a 200 weekly moving average, a 26 weekly moving average, and a 40 weekly moving average. And I know we're displaying the 26 and the 40, and I'll tell you why. The 26 and a 40 represents 2 3/4. And since as investors we look at the market on a quarter over quarter basis, that tells me how prices are reflective on a quarter over quarter basis. So our price is actually increasing even though we've got downward earnings. That has shifted positive for the first time since the beginning of the bear market. So that's indicative that there is a base forming in technology. It's also forming in the S&P 500 and other indices. However, technology is leading the way and is coming over major milestones very much quicker. So the levels that I'm watching is consistent closes above that 2640 and 200 weekly moving average. When we look at moving averages, I also want to look at the slope as well as where the index is above or below. So it's above, it's well above, it's beginning to slope upwards. That tells me it's the beginning of a bullish trend. And again, the way that you can verify that is if you look at the chart, you can literally see that the last time we were above that was in January of 2022. So that's amazing. That is a flip to a bullish narrative, but we have to see consistent closes. Now we're stuck in between this little area, and I want to see that gap that we formed, and we need to make a higher high, so overcome those lower highs that we did earlier within the bear market. But once we start overcoming those levels, which I believe that catalyst that's needed is going to be earnings, and once we get those earnings results, then we'll see if those levels will overcome.
Right, and we have there's a ton of tech earnings coming out next week, and you're trading this with NVIDIA.
I am. Even though NVIDIA it's certainly overhyped, and there is a lot of securities that have overhype within the AI world, NVIDIA is something that is utilized with everything. So instead of saying, okay, is Google doing better? Is Microsoft doing better? Who is creating revenue off of this to the end user? Both of those, or all of them rather, require something like NVIDIA. So therefore, it's a direct beneficiary of this hype of AI. So the way I like to trade that, especially when implied volatility is spiked, is through what's called a broken long call butterfly spread. It sounds complicated, however, it's just an extension of a long call. When we have a long call, you have unlimited gain potential, but we know that's unrealistic, or we have to set exit targets based on our support and resistance, or however you define those types of strategies. So when you create a bull call spread, we're just going to sell at our resistance point. But what we make it a broken wing long call butterfly is we double up our sell point at our resistance point, and then because we're adding another short call, that creates unlimited risks. We want to cap that, so it's broken because it's a different width. So for example, we're buying the 280s.
And excuse me just one second, but if we could pull that chart back up so we could take a look at the payoff and exactly the strikes and expiration that you're using there. So if we could, there we go, perfect.
There we go, yes. So June 16th, 60 days, that accounts for proper theta decay. Buying the 280s, selling 2 of the 300, so that's where my max gain is achieved right there. I want NVIDIA to go no higher than 300. However, if it does, I have to cap my risk potential that I created by doubling up on those short calls with the 300, and that's why I'm buying another 305, which is the farthest away from the money, which means it's the cheaper option. So overall, I'm spending $668, and I can collect about $1,300 max reward with this trade. And the purpose of this is really just to reduce how much it would cost to buy that long call. This long call alone is about, when I priced it earlier today, it was about $1,300, $1,600. By the way, putting this together, you literally removed $1,000 worth of cost.
All right, and I also love it too on the chart. It shows you where the trend is, what the score is, what your potential reward and risk is, which I think is really helpful on the OptionsPlay platform. It's easy to identify what your trade's going to look like.
Yep, absolutely, absolutely.
Appreciate the insight, Jessica. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.